China trapped in a debt crisis. Is India also walking the same path? Hello friends. A harsh reality about China, one of the world's most powerful and shining nations, has recently come to light, revealing its true economic condition. When we see China's towering skyscrapers, wide highways, and bullet trains, it appears that the country has already become a superpower in every sense. But the truth behind this glitter is quite different. Behind China's shine lies a dark pit of debt, so deep that even the country's income can no longer carry its burden. China's total debt has now crossed more than 3 times its GDP. Imagine this, China owes 3 times more than it earns in an entire year. This figure is not just alarming, it is a massive warning for the future. And not just for China, but for any country following a similar path. Today, we'll dive deep into this issue. But before we begin, if you are new to our channel, don't forget to subscribe so you stay updated with every new video. So let's begin without any delay. China's central bank, the People's Bank of China, has itself admitted the gravity of the situation. Deputy Governor 𝐟𝐨𝐥𝐿 revealed that China's macro leverage ratio has crossed 300%. This means that the government, corporations, and citizens combined owe 3 times more than their total annual income. Despite this, the government continues with the same outdated approach: lower interest rates, print more money, and pump it into the markets. The idea is that a loose monetary policy can keep the economy afloat. But the big question is, can a country really grow stronger by stacking debt upon more debt? China's M2 supply, which indicates the total cash and deposits in circulation, has now exceeded 200% of the country's GDP. This means the amount of money flowing in the economy is double what the country actually earns. Such excess liquidity can lead to financial instability and inflation. Experts believe that due to American tariff pressure, China is being forced to maintain this loose policy so that exports stay competitive and the domestic market remains active. But the side effect of this strategy is that the country is gradually mortgaging its own future and resources. The Chinese government is justifying its growing debt as a necessity for economic development. They say that if they want to progress rapidly, they must continue building roads, bridges, buildings, and factories, which requires investment, and for investment, borrowing is essential. 𝐟𝐨𝐥𝐿 says that the central bank will inject money into the market at the right time by reducing interest rates and the reserve ratio. But he also admitted that in the current global environment, conditions have become quite uncertain, sometimes due to geopolitical crises, sometimes due to fluctuations in financial markets, and sometimes due to the decline in globalization. All these factors are making the situation even more difficult for China. Now the question arises, if China's condition is this bad, what about India? Is India heading down the same path, or has it learned some lessons? Looking at the data, India's situation appears much more balanced compared to China. India's GDP is expected to reach $4.1 trillion by 2025, up from $3.4 trillion in 2023, indicating an annual growth of 6 to 7%. In comparison, China's GDP will be around $19.7 trillion, but its total debt is $59 trillion, more than 3 times its GDP. India's debt is currently around $7.4 trillion, which is 180% of its GDP. India's economic policy still appears to be measured and balanced. India is growing gradually, but it prioritizes financial stability. Instead of relying heavily on debt for growth, the Indian government is investing and expanding in a phased manner. This is why India's economy is currently in a stable and trustworthy position. According to a report by Business Today, India's total debt is around 85% of its GDP, while for China, it is 88%. But when the total debt of the government, companies, and individuals is combined, China's position becomes significantly worse than India's. The biggest difference between the economic policies of India and China is that China aggressively takes on debt to fuel growth, while India exercises caution and maintains balance. China believes its economy must move at superfast speed, so it keeps investing more and more, even if it means taking on huge amounts of debt. In contrast, India understands that without economic stability, growth cannot be sustained for long. Therefore, India has kept its debt under control and has maintained its fiscal deficit within limits. When it comes to foreign currency reserves, China holds around $3 trillion, which is one of its major strengths. India, on the other hand, has $600 billion in foreign reserves, much lower compared to China, but still adequate for India's needs. For China, a larger reserve acts as a buffer, but it also reflects how deeply its economy is tied to global imbalances. While India may have a smaller reserve, its utilization is more balanced and prudent. Another key difference is that India's domestic demand is becoming much stronger than China's. India's young population, startup ecosystem, and digital expansion are shaping it into a major power of the future. In contrast, China's population is aging and its domestic demand is declining. This divergence also impacts the economic stability of both nations. India is increasingly relying on domestic resources and innovation, while China is still pursuing growth through massive investment and infrastructure development. Looking at all these facts, it can be said that while China is heading toward an economic crisis, India has so far managed to keep itself safe from such a situation. However, this relief is not permanent. India, too, must remain cautious about its debt levels in the future. If we start borrowing recklessly, we could end up on the same path China is stuck on today. That's why it's essential for India to maintain balance in its economic policies, focus on social welfare, generate employment, and boost domestic demand. This will not only strengthen the economy, but also protect the country from global instability and lead it toward a self-reliant future. China's situation teaches us that the direction of growth is more important than its speed. The shine built on debt can one day turn to dust, but stable and balanced development truly makes a nation strong.
If our video has taught you something new, do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.